Welcome back to the channel, and welcome to today's deep dive. For 2 decades, if you asked a pension fund, an endowment, or a sovereign wealth manager how they hedge uncertainty, the answer was simple: gold. For thousands of years, gold has been the ultimate store of value, the safe haven in times of crisis, the shiny rock that every central bank holds in its vaults. But here's what's different now. In 2025, for the first time in history, the question isn't just gold or cash, it's gold, Bitcoin, and Ethereum. And the vehicle they're using isn't cold storage, isn't offshore trusts, and isn't even the futures market. It's the exchange-traded fund, the same wrapper they've used for decades for equities, bonds, commodities, and everything else in between. Spot Bitcoin ETFs have rocketed from zero to over $100 billion in assets in less than 2 years. BlackRock's iShares Bitcoin Trust alone sprinted past $80 billion this summer, making it one of the fastest-growing ETFs in history. Fidelity's product is close behind. And just months after launch, Ethereum ETFs have already posted billion-dollar inflow days, with Ether's trading volumes rivaling Bitcoin for the first time in 7 years. So the question today is, why are the world's biggest allocators now buying Bitcoin and Ethereum through ETFs, instead of simply buying more gold? Why is this shift happening, and what does it mean for the next decade of investing? Institutions aren't like retail. They can't just open Coinbase, buy some Bitcoin, and move it into a ledger. They have auditors, risk committees, regulatory reporting, custodians, and oversight boards. Every trade has to be explainable, repeatable, and defendable. For years, this was the wall that kept institutions out of crypto. But the ETF wrapper changed everything. When Bitcoin ETFs were approved, institutions could finally get exposure through the same systems they already use for equities and bonds. ETFs are familiar. They slot into the same portfolio accounting systems, the same custodians, the same rebalancing models. They provide daily liquidity, audited NAVs, and standard tax reporting. For a pension fund manager, buying IBIT or FBTC is no different operationally than buying SPY or GLD. That was the breakthrough. Suddenly, crypto wasn't exotic. It wasn't operationally dangerous. It was just another line item in a portfolio. And the timing couldn't have been better. Gold had already proven its worth as a hedge against inflation, but returns were flattening. Institutions wanted something with higher convexity, something that not only protected in certain regimes, but also offered asymmetric upside. Bitcoin and Ethereum fit the bill, and the ETF gave them the tool. Next comes the hidden math. Institutions care about basis points. Gold's flagship ETF, GLD, charges 40 basis points in fees. That's been the standard for decades. But Bitcoin ETFs came in lower, around 25 basis points for the big players like BlackRock and Fidelity. Ethereum ETFs came in around 20 to 25 basis points too. That's important, because now the cost of holding Bitcoin or Ethereum via ETF is actually cheaper than holding gold. Over a long horizon, that difference adds up, especially when scaled to billions. Then there's tax. In the US, gold ETFs are taxed as collectibles. That means long-term gains can be taxed as high as 28%. By contrast, crypto ETFs are taxed like equities, 0, 15, or 20% depending on your bracket. That's an 8-point swing in after-tax return, a material difference for large allocators. So on a net basis, Bitcoin and Ethereum ETFs offer not just a growth edge, but also a fee and tax edge compared to gold. And when you present that math to an investment committee, it's compelling. The third reason is scale. Early critics argued that Bitcoin markets were too small, too illiquid, too volatile for institutional money. But those arguments no longer hold. Bitcoin ETFs regularly trade billions of dollars a day. BlackRock's IBIT alone often clears more than $2 billion in daily volume. That's liquidity on par with major equity ETFs. The category as a whole now sits in the $150 billion range and climbing. Ethereum ETFs, though younger, have already proven that they can absorb billion-dollar inflows in a single session. That's the kind of liquidity that lets pensions, endowments, and sovereign funds allocate its size without worrying about moving the market. And remember, these institutions aren't trying to time bottoms or trade hourly candles. They want predictable exposure they can scale. Bitcoin and Ethereum ETFs provide that. Now let's talk portfolio theory, because this is where gold and crypto diverge. Gold has always been the classic crisis hedge. It performs well when inflation runs hot, when currencies weaken, when geopolitical tension rises. It's stable, it's boring, and that's its job. Bitcoin, on the other hand, is programmable scarcity. It has a capped supply, a predictable halving cycle, and global liquidity. Its volatility is higher than gold, but that's exactly why a small allocation can change the risk-return profile of a portfolio. Over the last decade, Bitcoin has shown near-zero long-term correlation with both equities and bonds. That makes it a diversification tool. Ethereum adds a different angle altogether. Ethereum isn't just a store of value. It's the base layer for decentralized finance, tokenization, and on-chain applications. For institutions, Ethereum represents not just an inflation hedge, but a growth technology play with real yield through staking economics. The result is that Bitcoin and Ethereum don't replace gold, they complement it. Together, they form a dual hedge stack. Gold provides stability in crises. Bitcoin provides scarcity-driven convexity. Ethereum provides network-driven growth. For allocators who care about protecting against multiple scenarios, the mix is more powerful than gold alone. Look at the numbers. BlackRock's IBIT became the fastest ETF in history to hit 50 billion in assets, then 80 billion. Fidelity's FBTC isn't far behind. Together, these two funds control more than half of the Bitcoin ETF market. The entire Bitcoin ETF category now rivals mid-sized sectors of the equity ETF market. Ethereum ETFs, though new, have already logged days with over 1 billion in net inflows. In August, Ether's spot trading volume overtook Bitcoin's on centralized exchanges for the first time in 7 years, a clear signal of shifting institutional interest. Meanwhile, gold ETFs are also seeing inflows. Central banks are buying record amounts of gold, and GLD remains massive. But the point isn't that gold is failing. The point is that Bitcoin and Ethereum are now joining gold as co-equal allocation tools. They're not replacing gold outright. They're expanding the toolkit. Zoom out to the macro. Interest rates are expected to start cutting again soon. Inflation hasn't disappeared. Geopolitical risks are everywhere. In that environment, institutions don't just want safety. They want convexity, assets that can both hedge and grow. Gold is great at hedging, but it doesn't compound. It doesn't generate yield. Bitcoin, with its halving cycle and growing acceptance, offers scarcity-driven upside. Ethereum, with its staking economics and network activity, offers yield-adjacent returns and exposure to a new financial system. That's why you're seeing institutions carve out room for crypto ETFs. They want both protection and potential. Gold gives them one. Bitcoin and Ethereum give them both. Now, let's be fair. Bitcoin and Ethereum still carry real risks. They're volatile. They can draw down 30 to 50% in bad macro windows. They face regulatory overhangs and narrative risk. Gold, by contrast, almost never delivers that kind of pain. That's why most institutions aren't going all in. They're allocating small slices. 1 to 3% of a portfolio. Enough to move the needle, not enough to blow up the ship. That sizing reflects the reality. Crypto is still risky, but the risk-reward trade-off is now too attractive to ignore. The big question now is whether Bitcoin and Ethereum ETFs can one day rival or surpass gold ETFs in size. Gold ETFs currently control hundreds of billions in assets. But Bitcoin ETFs are already in the 150 billion range less than 2 years after launch. If flows continue at this pace, it's not impossible that crypto ETFs match gold ETFs within a cycle or two. And if that happens, the psychological shift will be enormous. Gold will no longer be the sole hedge asset in institutional portfolios. It will be one of three, alongside Bitcoin and Ethereum. And that's a generational change in how money is managed. For everyday investors, the lesson is simple. The biggest pools of capital in the world are no longer ignoring crypto. They're not betting everything, but they are allocating. They're doing it through the same tools they use for gold, equities, and bonds. And they're doing it because the math, the liquidity, and the narrative all line up. This doesn't mean Bitcoin or Ethereum will go straight up, but it does mean that the bid is deeper, the flows are broader, and the adoption curve is accelerating. And that changes the game. If you're holding Bitcoin, Ethereum, or any crypto at all, don't leave it sitting on exchanges. Secure it with a Ledger hardware wallet. The link is in the description. Take control of your keys before the next headline reminds everyone why self-custody matters. Now back to the story. Gold is still the king of crisis hedges. But Bitcoin and Ethereum, delivered through ETFs, have become the new contenders in the institutional playbook. The wrapper solved the operational headaches. The fees and taxes made the math competitive. The liquidity proved the scale. The portfolio construction benefits made it logical. That's why institutions are now investing in Bitcoin and Ethereum ETFs, rather than just gold. It's not about replacing the old, it's about expanding the tool set. Gold provides safety. Bitcoin provides scarcity. Ethereum provides growth. Together they form a modern hedge stack that answers more scenarios than gold alone ever could. And that's why this story isn't about hype. It's about evolution. It's about how the biggest money in the world adapts to new tools, new assets, and new realities. Make sure you're following us on Spotify for more deep dives like this. And as always, we will see you at the top.